Stocks under some pressure. Bonds kind of been that way, but have been fairly quiet since a little selling this morning. Collin Martin joins me. Taking us into the bell, director and fixed income strategist at Schwab Center for Financial Research. Collin, we've got inflation tomorrow, and we've got bonds still pretty much in the low fours, but the last couple of days, yields trying to creep up. Does that make it interesting?
It makes it a little bit interesting coming off the low we saw on Friday, kind of the lowest we saw over the past 2 months. When we look at what to expect tomorrow, I'd say yields right now are likely reflecting those consensus expectations. That's what we've seen over the past few inflation reports. As long as the data comes in, meeting expectations, even if a little bit hot relative to what we're looking for or what, Fed is hoping for, if they meet expectations, we haven't seen much of a reaction to the bond market. So even though we're expected to see core CPI come in at 0.3%, at least that's a consensus expectation on a month-over-month basis, that'd be the fourth straight month with that reading. That's too high for inflation to get down to the Fed's 2% target. But again, if it does that, markets I think are priced for that. If we're looking for what could happen, either upside or downside, if we saw a number come in a little bit hot, I'd expect to see Treasury yields rise. That might not be enough to take a rate cut off the table next week. The implied probability of that's over 80% right now, but it likely changes the timing of the potential cut after that. Markets and we are expecting a pause at some point in early 2025. If we get a hotter than expected reading, it's more likely that pause would probably come early in the year.
Okay. And that is where the, debate now has shifted, right? So it'd have to be a real shocker, a real barn burner to change D's?
Yeah, I think so. The Fed does not like to surprise the markets. They like to kind of get their word out there. They like to manage expectations, and they don't want to do something that's really going to throw a ripple anywhere. So I think that the Fed, they have an idea of what CPI will look like this month. Not that they're getting that advanced read, but they know what everything's pointing to. They see what consensus expectations are. So knowing that we'll probably see a 0.3% increase on a month-over-month basis, knowing that we'll probably see core CPI on a year-over-year basis hold steady at 3.3%. Fed officials know that and have already sort of guided towards that cut. So like you said, unless we get a real shocker of a number, I don't think it's going to throw the Fed off its course.
Okay. So then next year seems like it's very much kind of up for grabs. 13.5% unch for in a week or whatever is still kind of interesting, but I hear you there. The Fed doesn't want to surprise at 86%.